Hello student, welcome back to balance sheet overview. We are going to learn about use of balance sheet. So let's understand the use of balance sheet, or why do we create balance sheet and what is their potential use. The purpose of balance sheet is to provide key insight to company asset, liability, equity, adding various analysis. With the help of balance sheet analysis, we do the key assumption like liquidity, solvency, financial flexibility and risk. These are the information we will get through balance sheet. Solvency is for long term and liquidity is for long term. How much current asset we have to meet our current liability, how much long term asset or fixed asset or investment we hold to meet the long-term obligation kind of stuff. Financial flexibility evaluate the company ability to adapt cash flows to meet the unforeseen need and seize opportunity. So how much cash and other thing we have so that we can easily grab the opportunity kind of stuff. And the risk that will also help you if in case if we are suffering from liquidity or solvency issue or any other issue, that will help the user of balance sheet to predict and take necessary action for future event, or anything is going to impact to your business or cash flow. Rate of return that also help you to how much we are going to earn after based on our investment. That will also help. Capital structure, how much debt and equity you have and how much you are financing your business based on that, and how much you have equity from your owner investment kind of stuff. Future cash flow, how much you have ability to generate in cash in future. That is all you get it from balance sheet. And one drawback is balance sheet will not give all the information, so that is why you need to also read the cash flow to fully understand with regard to liquidity and solvency and financial flexibility. Because in current asset and current liability we may book accrued liability, accrued expenses kind of stuff based on matching principle kind of stuff, but and also we have non-cash items. Those are the thing is available in balance sheet and your income statement. So that is why that all thing has been removed by cash flow. When we will jump to cash flow, that time we will learn in more detail. Key point: balance sheet help assess company financial health. Obviously balance sheet will help you to understand the health of the organization and ability to pay debt or not. For that company you will buy the share or not, that is your decision. Obviously if they are not able to pay their debt, then how they will pay to their equity holder or shareholder. So capacity, and also help to provide return on investment, what I was discussing, whether they will able to give good return to the investor or not. So these are the information you will directly get it from balance sheet, and what you will not get, you will get it at your cash flow. So now we will understand few limitation of balance sheet. Incomplete asset reporting: some valuable asset like employee, process and competitive advantage are not listed in balance sheet because that is not possible. Even goodwill is, when we evaluate, that time we mention in our balance sheet. But suppose you have thousands of employees, they all are very effective. Your HR team is very good, your finance team is very good. They have potential to give you good growth, but you cannot measure it and you cannot update in your balance sheet. But these are your asset. Employee is your asset, your process is your assets. Because I have seen a lot of company who don't have internal control, they are losing millions of dollars every year. People are taking advantage and people are getting benefit. There are a number of employee who is working to those kind of companies, they are doing nothing but they are getting good salary. So these are the thing happen when you have no good HR, no good better process, you have no good control kind of stuff. So when you create this kind of control, your net profit will increase. So net profit will come into your income statement, and then return earning that will come in future. Okay, but when you apply this, you already have good employee or something, so that they are keep on saving and they are keep on increasing your net profit, which you might end up losing every year. So those company who is losing, since they don't know, for their net profit is their real profit. But when you have such kind of employee who is impactful and your net profit is high, so also you don't know, so you think this is your net profit, which is this is my net profit, okay, this is my percentage, you will know. but you are earning because of this kind of employee, which you might not realize, and this company who is losing those money, they also not realize. So this is a very hidden kind of secret which I am explaining. So employee process, competitive advantage, you are having such kind of competitive advantage. Those competitive advantage you cannot calculate, like you have good SWOT analysis, you have good pricing strategy, you have good marketing strategy, you are segmenting, you are focus target, whatever the pricing and policy you have with regard to beat your competitor and defeat your competitor, and you are keeping eye on your competitor, and you are making such kind of steps, you are investing, you are buying asset, fixed asset kind of stuff too, or you are making innovation and automation in your company, so that you can reduce your cost and you can increase the profit, and you can reduce the selling price of your product, so that demand will increase. So everything is linked. So all I'm trying to say, you are competitive advantage, but you cannot measure it. So that is why it will not reflect into your balance sheet. This is the limitation. This limitation will remain forever. I don't think upcoming 20 year or 30 year this kind of limitation will go. No, you will create some kind of reporting where you will put note and you can mention about your quality of your employee, labor, policy, process kind of stuff. This thing you can mention. If you are not mentioning, but still company like Microsoft and Google and other such kind of Apple or Tata Motor, this kind of company are giving proof by their financial statement every year. They are consistently growing, they are expanding. So these are the reflection of their all those this kind of thing which we cannot update in balance sheet, but due to their performance we can assume that they have good pricing strategy, they are using their asset more effectively, they have good employee, good process kind of stuff. We can assume, we can feel. Historical cost asset are often reported based on historical cost, maybe for land these are the cost, or other fixture furniture you have purchase cost, you have purchased and you are keep on depreciating the asset. But what happened, this cost has been increased for the period of time. Maybe your building cost is also increased, though your building is old, but still due to locality or some other reason, their overall your building and land value both has increased, but you are following the historical cost and you are keep on depreciating the asset. So that is not fair value. Okay, these are the demerit. Still we have IFRS US gap has given some suggestion to make update their fair value and check their impairment kind of stuff. So keep on checking this kind of thing and update your cost. Normally impairment is for to book the losses, or in case of your asset got damaged or something, for that you will do the impairment testing and you will book the losses. Okay, estimate and judgment, many figures are based on estimate. For example, bad debt, you have 10 millions of account receivable. Out of 10 million, you are seeing historically how much percentage we are losing and we are not getting return after next year and to next year. So based on that assumption, you might be taking bad debt. So that is what it is talking about. So whatever, so that figure you are taking 2% is your historical data. So again, you are taking historical based data, you are taking 2% of your total AR and booking your bad debt kind of stuff. So these are provision based on your assumption. Receivable, the same thing is talking about. Depreciation based on estimated useful life. Maybe for building you have estimated 20 years and you are depreciating, but maybe they have 50 years and 80 years of life. Nobody knows how much exactly the life is, but it has been normal, whatever the government and regulation are telling you to take useful asset life. So they are not strict with regard to years, how much years you need to consider your building. At least normally people are considering 20 years. For example, for computer and other IT equipment we are taking 3 years. So this is the way we are depreciating, but normally you can see laptop may go more than 3 year, 5 year or 7 year we are using. This is the demerit they are talking about. Now warranty liability, with regard to you are selling your product, and along with product you are giving warranty. For warranty, again the historical data, how I explained about bad debt, based on the historical data how much we are incurring our expenses for fulfilling the maintenance with regard to warranty. Based on that we are booking our expenses, and based on that we are taking estimates. So this is what the demerit, limitation I would say. Liability valuation, liability are recorded based on historical interest rate and not current market rate, which may be affect their reported value. Obviously it is right, whatever the historical interest rate we have, based on that we are booking our liability. Current trend, fair value measurement, increasingly used to asset and liability, to including derivative to reflect current market condition. So fair value measurement are also we do. Okay, so basically fair value is trying to measure the interest rate. Maybe for bond or something, you have decided your interest rate to be paid 10% or something, but later on if market has some other inflation or deflation, or interest rate has been increased, so that time you have to update all your liability valuation based on the market share. So what will happen, you will be representing your balance sheet true and fair and transparent. Okay, so this is what it is talking about. Key point, balance sheet provide the snapshot of financial position, but does not fully capture the company overall value or current asset and liability valuation, which is very accurate. Balance sheet provides a snapshot of financial position but does not fully capture. It is not possible to capture fully, as I have spoken here also, as for liability point of view, and other things are based on judgment and few things are based on historical data. This is the fact actually which we cannot able to overcome. So I hope it is clear to you. So I think I'm done for the day. We'll see you into the next session. Thank you very much. Stay tuned.